Ever hear people throw around words like stocks, dividends, or bull markets and wonder what they actually mean? In the next few minutes, you'll master 100 of the most important terms in finance, explained with real examples you will understand. Let's start with basics. A stock represents ownership in a company. If you owned 1% of Tesla's stock, you'd literally own 1% of Tesla's factories, cars, and profits. A share is one unit of ownership in a company. If Apple were cut into 10 billion slices, each share would be one of those slices of ownership. A shareholder is anyone who owns one or more shares. If you own even one share of Coca-Cola, you're officially a part owner of the company and share in its success. Equity is what's left after a company pays its debts. If McDonald's owns $100 billion in assets, but owes $40 billion, shareholders own the remaining $60 billion in equity. A public company is one whose shares are traded openly on a stock exchange. Amazon and Disney are public, so anyone can buy a piece of them on the market. A private company is one owned by founders or investors and not sold to the public. SpaceX is private. Unless invited, you can't buy its shares. A stock exchange is the marketplace where shares are traded. The New York Stock Exchange and NASDAQ are digital arenas where billions of dollars of stock trade daily. A ticker symbol is the short code used to identify a company's stock. AAPL stands for Apple, TSLA for Tesla, KO for Coca-Cola. It's like the company's handle on Wall Street. Market capitalization, or market cap, is a company's total market value. If Apple's stock is $180 and there are 16 billion shares, Apple's market cap is about $2.9 trillion. An index tracks the performance of a group of companies. The S&P 500 represents America's 500 largest companies, showing how the overall market is doing. Revenue is the total money a company earns from sales. When Starbucks sells a $6 latte, that $6 adds to its revenue. Expenses are the costs of running a business. For Starbucks, that's coffee beans, milk, wages, rent, and advertising. Net income is what remains after expenses, the profit. If Starbucks earns $1 billion and spends $700 million, the remaining $300 million is net income. Profit margin shows how much profit a company keeps per dollar of sales. If Apple keeps 25 cents out of every $1 earned from iPhones, its profit margin is 25%. Operating margin measures profit from core operations before taxes or interest. Nike's operating margin shows how efficiently it turns shoe sales into profits. Book value is what a company would be worth if it sold everything and paid its debts. If Ford sold all its factories and cars, the leftover money after debts would be its book value. Earnings per share, or EPS, is profit divided by the number of shares. If Microsoft earns $80 billion and has 8 billion shares, each share earned $10. A dividend is money a company pays its shareholders from profits. Coca-Cola sends out a cash payment to investors 4 times a year. Dividend yield compares a dividend to the stock's price. If Coca-Cola pays $1.80 per share yearly and trades at $60, its yield is 3%. Return on investment, or ROI, measures profit compared with the money invested. Invest $1,000 in Tesla and sell for $1,200, a 20% ROI. Return on equity shows how well a company uses shareholders' money to make profit. If you're still here, you already understand more than most new investors, and it's about to get even clearer. Procter & Gamble earns about 20 cents for every dollar of equity. Debt-to-equity ratio compares borrowed money to owned money. A ratio of 2 means the company has twice as much debt as equity. Intrinsic value is what a company is truly worth based on its performance, not its stock price. If Nike's real value is $120 per share, but it trades at $100, it might be a bargain. Value stocks are solid but underpriced. Coca-Cola is a classic value stock, steady profits and fair pricing. Growth stocks are companies expected to expand quickly. Tesla and Nvidia are growth stocks, trading on future potential. Blue chip stocks are large, reliable companies with strong histories. Apple, McDonald's, and Johnson & Johnson are examples of blue chips. A portfolio is the collection of all your investments. If you own Apple stock, a bond, and an S&P 500 ETF, together they form your portfolio. Diversification means spreading money across different investments to reduce risk. Owning tech, energy, and healthcare stocks means one bad year won't wipe you out. Risk tolerance is how much loss you can handle emotionally. Someone who panics during a 10% dip has low tolerance. Warren Buffett clearly doesn't. A bull market is when prices keep rising and optimism rules. The long run from 2009 to 2021 was one of history's strongest bull markets. A bear market is when prices fall for months and fear spreads. The 2022 downturn in tech stocks was a bear market. A correction is a short-term 10 to 20% drop after big gains. If the S&P 500 rallies, then falls 15%, it's just correcting itself. A crash is a sudden, severe price drop. The 2008 financial meltdown was a full-blown market crash. Volatility is how much a stock's price moves. Tesla swings wildly, Coca-Cola barely budges. Liquidity is how easily something can be bought or sold for cash. Apple stock sells instantly. A tiny startup might take days to find a buyer. Volume is the number of shares traded in a day. If 100 million Apple shares change hands today, that's its trading volume. Dollar cost averaging means investing a fixed amount regularly, no matter the price. Putting $100 into an S&P 500 ETF every month smooths out market ups and downs. A long-term investor buys and holds for years. Someone who bought Amazon in 2010 and still holds it today is playing the long game. A value investor looks for underpriced companies. Warren Buffett buying Coca-Cola decades ago is the classic move. A growth investor seeks companies expanding fast. Buying Nvidia or Tesla for their future growth fits the style. A dividend investor focuses on steady cash payouts. Owning Johnson & Johnson means getting paid just for holding shares. Still following? Perfect. You're building an investor's mindset. Let's jump into how trading actually works. An index investor buys funds that track whole markets. Investing in an S&P 500 ETF means you own small pieces of 500 companies. A broker or brokerage is the service that executes your trades. Robinhood, Fidelity, and Schwab are the middlemen between you and the market. A commission is the fee a broker charges per trade. Most online platforms have dropped it to zero to attract investors. A market order buys or sells immediately at the best price available. Tap buy on Apple at $180 and it executes right away. A limit order lets you choose the price you're willing to pay. If Tesla trades at $250, but you only want it at $240, your order waits there. A stop-loss order sells automatically when a stock falls to your limit. Buy Amazon at $130 and set a stop at $115 to cap your loss. A trailing stop order follows the price upward, protecting gains as it rises. If Nvidia climbs from $400 to $500 and you set a 10% trailing stop, it sells if it drops below $450. A good till canceled order stays open until it's filled or you cancel it. If Coca-Cola never hits $55, your order just sits there until you cancel it. A day order expires when the market closes. If your order isn't filled by 4 p.m., it disappears. A fill or kill order must execute instantly in full or not at all. If you try to buy 10,000 Apple shares, but only 9,000 are available, it cancels. The bid is the highest price buyers will pay. The ask is the lowest price sellers want. If Apple's bid is $179.90 and ask is $180, that penny gap is the bid-ask spread. Going long means buying a stock expecting it to rise. If you buy Tesla now, hoping it hits $300, you're going long. Short selling means borrowing shares and selling them now to buy back cheaper later. If you short Tesla at $250 and it falls to $200, you pocket $50 per share. Buy to cover means closing that short position by buying back the borrowed shares. You return them to your broker and lock in your profit or loss. A short squeeze happens when shorted stocks rise fast, forcing sellers to buy back and pushing prices higher. GameStop's 2021 rally was the ultimate short squeeze. A market bubble happens when prices rise far beyond real value due to hype. The dot-com bubble of the late 1990s popped when profits didn't match the excitement. Panic selling is when fear spreads and everyone rushes to sell. March 2020 saw investors dump stocks at any price during the COVID crash. A black swan event is a rare, unexpected shock that hits markets hard. The pandemic shutdown was a textbook black swan. Fear of missing out drives people to buy because everyone else is. In 2021, many jumped into Dogecoin simply because it was going to the moon. A pump and dump is when scammers hype a keep stock, drive it up, then sell for profit. When they dump it, late buyers are left holding the bag.
You're now deep into how markets move. Keep going. The next part will make you sound like a pro investor. A rug pull is when crypto creators vanish with investors' money. One day there's a token, the next day the website and funds are gone. Whales are giant investors whose trades move markets. When Warren Buffett buys billions in Apple, everyone notices. Unicorns are private startups worth over $1 billion. SpaceX, Stripe, and Canva reached unicorn status before going public. To the moon is slang for a stock expected to skyrocket. GameStop traders chanted it online as the price exploded. Tanking means a stock's price is falling hard. When Netflix lost millions of subscribers in 2022, its shares tanked. Penny stocks trade under $5 and swing wildly. Tiny biotech firms often live here, big dreams, big risk. Defensive stocks are steady companies selling essentials. People still buy Colgate toothpaste and electricity even in recessions. Cyclical stocks rise when the economy grows and fall when it slows. Ford and Delta Airlines boom in good times and struggle in downturns. Speculative stocks are high-risk bets on uncertain futures. A new AI startup with no revenue fits this category. A bond is a loan you give to a company or government for interest payments. Buy a U.S. Treasury bond, and the government pays you back with interest later. An ETF, exchange-traded fund, is a basket of stocks trading like one stock. Buying an S&P 500 ETF gives you instant exposure to 500 companies. A mutual fund pools money from investors and is managed by professionals. It's like hiring a team to invest your money across many assets. An index fund tracks an index instead of trying to beat it. A Vanguard S&P 500 fund simply mirrors the market. A REIT, real estate investment trust, owns properties and pays investors from rent. Buy one and you earn income like a landlord without owning buildings. A hedge fund is a private investment pool using complex strategies to outperform markets. They often cater to wealthy investors who can handle higher risks. Commodities are raw materials like oil, gold, or wheat traded globally. When oil prices rise, airlines feel it immediately. An IRA, individual retirement account, helps you save for retirement with tax perks. A Roth IRA lets your investments grow tax-free. A holding company owns other companies rather than making products itself. Berkshire Hathaway owns GEICO, Dairy Queen, and dozens more. Control stock is a big enough ownership stake to influence decisions. Elon Musk's large Tesla stake lets him shape company direction. Nice! You've made it this far. You're understanding the language of the pros. Let's finish strong with more advanced concepts. Fundamental analysis studies a company's finances and business to decide if its stock is worth buying. Looking at Apple's sales, profits, and balance sheet is fundamental analysis. Technical analysis studies price charts to predict future moves. If Tesla's stock breaks a key pattern, traders see a signal. The price-to-earnings ratio shows how much investors pay per dollar of profit. If Apple trades at $180 and earns $6 per share, its PE is 30. The PEG ratio adjusts the PE for growth rate to find fair value. A PE of 30 with 30% growth gives a PEG of 1, often considered balanced. The price-to-book ratio compares a stock's market price to its book value. A PB below 1 may signal a cheap stock. A moving average smooths out price swings to show trends. Traders watch the 50 and 200-day lines to spot momentum. MACD, moving average convergence divergence, helps spot when momentum changes direction. When its lines cross, traders see possible buy or sell signals. RSI, Relative Strength Index, shows if a stock is overbought or oversold on a 0 to 100 scale. Above 70 can mean too hot, below 30, too cold. Support and resistance are levels where prices tend to stop falling or rising. If Tesla keeps bouncing near $200, that's support. Fibonacci retracement uses math ratios to estimate where pullbacks might pause. Traders use it to plan entries after big moves. Alpha measures performance versus the market. If your portfolio gains 12% while the market gains 10%, your alpha is +2. Beta measures how much a stock moves compared to the market. A beta of 1.5 means it swings 50% more than average. The Sharpe ratio shows return per unit of risk. Higher ratios mean better risk-adjusted performance. The VIX, or Volatility Index, measures expected market turbulence. When it spikes, fear is high and markets are jumpy. Leverage means using borrowed money to amplify results. It doubles gains when right and doubles losses when wrong. A margin account lets you borrow from your broker to buy more stock. It's powerful, but losses hit twice as hard. Futures are contracts to buy or sell assets at a set price later. Airlines use oil futures to lock in fuel costs. Options give the right, but not the obligation, to buy, call, or sell put at a set price. They're like insurance policies for stocks. The efficient market hypothesis says stock prices already reflect all known info. That's why beating the market consistently is so hard. Diversification versus concentration means spreading your money across many assets or focusing on a few. Most investors diversify, owning Apple, Coca-Cola, and index funds instead of betting it all on one pick. And that's it. 100 core investing terms explained simply and clearly. If you understood these, you now speak the language of money. If you find this video helpful, tap like and subscribe for more simple finance stories.